Hawkish central bank repricing is colliding with an AI earnings boom, and equities are caught between higher yields and powerful growth stories. This is vTalkInsight, Equity Pulse Daily for June 23, 2026. Let us unpack how the evolving rate path, inflation data, and a wave of AI and healthcare news are reshaping the risk and opportunity set across global equities today. Equities are now trading against a meaningfully more hawkish Federal Reserve backdrop, with several major banks talking about as much as 75 basis points of further tightening this year. Expectations have moved toward 2 or even 3 U.S. rate hikes, potentially starting in September or December, and that repricing has pushed Treasury yields to new yearly highs, especially at the front end of the curve. Short-dated U.S. yields are climbing while the gap between 2-year and 10-year Treasuries has narrowed to under 30 basis points, reinforcing a bear-flattener that often reflects concern about the longer-term growth outlook. Compared with just a few days ago, when a prolonged pause looked more likely, the market now assigns greater weight to renewed tightening, and that is feeding directly into the discount rate applied to equities. At the same time, the Fed has stepped back from detailed forward guidance, which leaves investors more dependent on plots, speeches, and incoming data to infer the policy path. Upcoming U.S. PC inflation is a key focus, with core readings expected around 0.3% month-on-month and roughly 3.4% year-on-year, and any upside surprise on Thursday could be a genuine volatility event for both bonds and stocks. Fed Chair Kevin Warsh is also weighing how AI-driven productivity gains might offset inflation, echoing Alan Greenspan's decision in the 1990s to look through some price pressures during a technology boom. However, other parts of the data point to broad inflation pressure, from healthcare costs to non-energy producer prices, and history suggests that when inflation stays above 3%, stocks and bonds often become positively correlated, raising the risk that both could sell off together if rates rise further. Energy markets are no longer the dominant macro anchor they once were, even though progress in U.S.-Iran talks and an interim reopening of the Strait of Hormuz have pushed oil prices down nearly 2% and increased vessel traffic, including empty LNG tankers heading back to Qatar. Oil's influence on global asset pricing has faded with electrification and ample fossil fuel supply, while U.S. Treasuries remain the primary safe haven in geopolitical stress, and central banks have been steadily increasing strategic gold purchases, even as higher yields can blunt gold's defensive appeal during supply shocks. Against this more challenging rate environment, earnings are still doing a lot of the heavy lifting for equities. U.S. corporates have delivered robust profit growth for several years, and AI-driven capital expenditure plus a broadening of sector-level earnings are seen as strong enough, for now, to counteract some of the valuation headwinds from higher inflation and interest rates. Upward earnings revisions for the S&P 500 have slipped from the very elevated 89 to 90% range down toward 86%, so momentum has cooled slightly, but remains net positive. Recent price action fits that narrative, with the S&P and Nasdaq capable of rallying strongly on good news, particularly in semiconductors, even as volatility drifts back into the high teens and daily moves turn choppier. At the same time, valuation concerns are hard to ignore, with U.S. equities trading near 23 times earnings and some indicators of market exuberance flashing in double digits for the first time since the global financial crisis. AI-related semiconductor stocks look especially stretched after extraordinary price and earnings gains, feeding a bubble debate that sits uncomfortably alongside the very real prospect of AI lifting trend growth and productivity across the economy. Market leadership is no longer a one-way bet on the mega-cap technology complex. Equal-weight versions of the S&P 500 and the Russell 2000 have pushed to new highs, with the Russell up about 43% over 12 months and above 3,000, while sectors like healthcare and banks, including names such as Eli Lilly, have been taking more of the performance baton. There are sessions where cyclicals and economically sensitive shares outperform, with the Dow and small caps in the green even as the S&P 500 and Nasdaq slip, highlighting rotation away from pure growth and long-duration tech. Small caps are widely viewed as undervalued relative to large caps, with upside if growth holds and eventually rates ease, although their heavier exposure to financing costs and upcoming debt maturities makes them more sensitive to any credit tightening. In Europe, dispersion is also pronounced, with defense groups such as Rheinmetall outperforming on expectations of higher defense budgets, while Babcock has sold off sharply after disappointing earnings despite announcing a new buyback and offering a constructive outlook. By contrast, consumer-facing sectors remain under pressure given weak demand and a recovery thesis that still hinges on both a more durable Middle East peace and a revival in Chinese consumption. The AI infrastructure build-out is turning into one of the defining capital cycles of this decade, and it is reshaping equity narratives across semiconductors, energy, and industrials. TSMC is planning more than $200 billion of multi-year capital spending to defend its technology lead. Samsung is expanding memory capacity with customers helping to fund it, and memory players like Micron are benefiting from persistent supply-demand imbalances in AI hardware. Power is emerging as a hard constraint, illustrated by Microsoft's 2.6 gigawatt natural gas deal with Chevron to support data center expansion in Texas, a move that marks a step away from strict renewable sourcing, but provides the scale needed for AI workloads. This kind of deal underlines how AI demand is pulling through investment not just in chips but also in grids, generation, and energy infrastructure, blurring the lines between technology and traditional utility or energy sectors. On the funding side, SpaceX is entering the investment-grade bond market to refinance debt that previously cost more than 12% down toward roughly 4%, while also preparing a potential $20 billion issuance to finance satellites and its Colossus data center business. With major AI clients such as Reflection, Anthropic, and Google already on board, SpaceX exemplifies how capital markets are willing to fund large, long-dated AI and infrastructure projects even when free cash flow is still negative. This surge in investment comes as some strategists warn that declining Treasury buybacks and faster bank lending could tighten overall liquidity, even though many corporates still report strong cash flow and see little immediate stress. At the same time, reduced buybacks from big tech, historically low cash holdings relative to equity market capitalization, and a pipeline of large private companies valued at around $8 trillion eyeing IPOs, plus a wave of AI-related listings over the next year, all raise questions about how smoothly markets can absorb rising equity and debt supply. In credit, default rates in public loan markets have risen toward levels last seen during the global financial crisis, with software sector loans and highly leveraged borrowers facing upcoming maturities amid scarce capital. That strain is showing up in private credit, where some funds have restricted withdrawals after $13 billion of redemptions in the first quarter, yet investment-grade credit is still viewed as resilient, and private credit yields, while compressed, continue to offer a noticeable premium over public markets. At the stock level, Micron has become a focal point for the AI trade, with shares rallying as tight memory supply supports pricing and as the company deepens strategic ties with leading AI players. The recent partnership with Anthropic on AI-focused memory and storage sent Micron up about 5%, and upcoming earnings will be scrutinized for signals on capacity expansion plans, which effectively reveal management's confidence in the durability of this demand cycle. AI is also driving dramatic repricing elsewhere, as shown by Getty Images, which surged nearly 200% pre-market and still finished up close to 90% after unveiling a licensing deal that allows its content to be used within OpenAI's platforms. In healthcare, Apogee Therapeutics jumped more than 50% on reports that AbbVie is preparing a multi-billion-dollar acquisition to expand its anti-inflammatory pipeline, with analysts seeing the combination of Rinvoq, Skyrizi, and new assets as capable of generating $50 to $60 billion in annual sales and challenging Sanofi's Dupixent franchise in atopic dermatitis. Elsewhere, EasyJet has rejected 3 takeover approaches from Castlelake, including a bid at a sizable premium, yet the muted share price response suggests investors are either skeptical or waiting for a clearer proposal as the bidder lines up experienced airline executives like Peter Bellew. By contrast, Alamos Gold has sold off sharply after a localized seismic event forced a cut to production guidance at its Davidson mine, with output not expected to normalize until 2027, underscoring how operational shocks can overwhelm longer-term themes such as increased central bank gold demand. Putting it all together, equities are sitting at the crossroads of a hawkish Fed repricing, persistent but evolving inflation, and an AI-driven earnings and capex cycle that is transforming both growth expectations and capital flows. Yields near yearly highs and a flatter curve are pushing up the equity risk premium, just as valuations, especially in AI-linked semiconductors, look demanding, even though earnings revisions remain broadly positive and leadership is broadening into small caps, healthcare, banks, and selected cyclicals. At the same time, the sheer scale of AI and energy transition investment, from TSMC's multi-year capex to Microsoft's power deals and SpaceX's bond plans, is testing liquidity, while private credit stress, UK political uncertainty, and idiosyncratic stock moves from Micron to Getty Images and AbbVie highlight how dispersed outcomes have become beneath the index level. From here, the key signposts are the upcoming PCE inflation data, S&P global PMIs, the behavior of the two-year yield and credit spreads, the trajectory of earnings revisions, and how the market digests the approaching wave of AI and private company IPOs. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.